Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about how it's not easy to invest, how it's not easy to deal with recession, and could the Federal Reserve raise rates out of cycle. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. The theme of the day is how investing is not easy. How can investors keep things in perspective when faced with the down markets?
Well, good morning, Allison. And yeah, yesterday was about as tough as it could be for investing, right? So, I put some notes here on the Post-it. Worst day since June of 2020, where people had kind of gone numb after March of 2020 and then April run up and then some market adjustment there in June. So it's been a couple of years since we've really seen a big down day like that. For Target and Walmart, which we're going to talk a little bit here in a minute about the retailer selling off and what that forecast, that was their worst day since 1987. So, and then of course we have inflation raging and gas prices going higher. So a lot of things to talk about today. But and on today's show will be a little bit instructive of what was going on in the 80s, what the Federal Reserve was doing. So hang in there towards the end and I will cover that. But as far as, marking the bottom, I thought the bottom was going to be in this area and it's actually held. I will say that the volume wasn't insane, which is one of the things you look at as far as when the bottom's in, the volume spikes, right? It goes out of control. So here you're looking at a one-year chart of the S&P 500, and the volume was not really even that notable, to be honest. If you look over to the right, it's that second kind of column down of all the reds and greens there. Second row down. So the volume wasn't insane, but it seemed like it, right? It wasn't an everybody selling everything mode. It was a lot of people are selling everything. Very few things were up. So, really across the board, didn't matter if how diversified or what allocation you had in your 401k. It didn't matter. It was all going down yesterday. Now, what's instructive is the pain you felt yesterday seemed like the world is ending. Well, look at the chart over here to the right. Realize we aren't even, we're where we were literally 1 week ago today. So, things, if you were to say something like, oh my gosh, that was so painful, things haven't been this bad since last week. Well, that's factually true, but that's how your emotions can get the better of you. Is all we did was go back to the lows of last week, where we, basically I said, there was before that, there was the stay calm past the ammo, then there was the hold the line, and we're still in kind of hold the line mode, if you will. Let me zoom in just a little bit though to show you that. So here is what is this, a 10, that's about a 10-day chart. So there, this move down was obviously significant yesterday because we retraced, the 4 days up prior to that. But really, you want to take a look at, zooming in to see where we were. We wasn't even as bad as last week. And then certainly if you go to a longer, a 3-year chart, that tells a different story, right? So sure, if you just started investing 6 months ago, this has been a house of pain. You're probably ready to take your football and go home, say this is all rigged, or call it BS, or move on from there. However, this was the COVID, this was the COVID hit. And it's starting to feel COVID-esque, right? And I will say a lot of this is self-induced too, but we'll get into that here in a little bit. So overall, as an investor, I empathize with the feelings that you're having. They're not uncommon. It does seem like the end of the world. When you think of the numbers, the NASDAQ numbers are in a bear market. Obviously, it's close to 30% off this morning, but neither the SPY or the Dow Jones are even in a bear market yet. Kind of crazy, right? So to put that in perspective, with the SPY not even down 20%, during 2007 and 2009, the SPY was down 53%. So could things get worse? Yes. Do I think the bottom's in? Yeah, I still do think the bottom's in, even though obviously some more negativity is getting priced in on a daily basis. But we'll also talk here in a little bit about some ways to mitigate that. So overall, hang in there, and we'll see how it plays out today. Today should be an interesting day.
Next, the odds of recession increased significantly this week with the negative retail numbers from both Walmart and Target. Are we going to see a recession?
Well, here's my official answer, and I don't mean to be glib with it or make light of the situation, but I do. I've switched camps based off of the information that's come to light this week. Is that so let's talk about that recession, right? The slowing of the economy, the Federal Reserve raising rates, we're battling inflation. Ultimately, Walmart and Target both said the same thing. Their input costs were higher than they expected, and they chose not to, or could not pass that on to consumer, right? So ultimately, they took a huge hit because they made that decision. You can't go back in time and figure out, well, if they would have just passed that on, how would have that? You can't do that. That's a hypothetical. But really, when you're looking at things like pricing power, right? What companies can pass stuff on to the consumer, and you think, well, tech can, right? Amazon could raise their prices, Google could charge more for advertising, the Apple can raise prices on their products, services, phones, all of that sort of thing, where certainly the smaller companies out there are going to struggle with that. But that's why when we invest, especially here at Ankerstar Wealth, we're looking for that higher margin, so that way when a recession does happen, it's only eating into it a little bit. But from the perspective of what is going to drive us into a recession, I think now, like literally this week, is when people are finally saying, okay, I get it. Inflation isn't going anywhere, because we thought we were at peak inflation. Evidently we're not, or if we are at peak inflation, it's certainly not receding back to where we thought it was. Nobody's sitting there saying it's going to be back to 2% by the end of the year anymore. I was at an economics forum yesterday afternoon, talked about this in depth. What does inflation look like by the end of the year? I think people would be happy if it was 5% or less, right? So still historically high, but at least under control and trending in the right direction. So what does that mean for the market? Well, that means probably not a V-shaped recovery. The whole COVID situation, lock everybody in their home, completely self-induced, led to an immediate sell off 35% and a huge snapback to new highs. Well, here with the market, this is a slow and steady as you go, combating, inflation. And now you're starting, I would not expect a V-shaped recovery. I would expect more of a bathtub. Are we in the bathtub now? I think so, because it has been so negative already. Okay. I think the worst is yet to come for the economy, but I think the market, which, gets way out in front of things, has already priced in a recession. I mean, 30% in the tech stocks already, almost a bear market in the Dow and S&P 500. We're there. We didn't wait for the recession to get here. We're already pricing it in right now. So that's why I think the near-term bottom's in. However, there are options in your portfolio. There are buffered ETFs that I'm starting to use for folks, especially that are showing concerns that I might bail on investing if I lose any more money, or you don't really lock in the losses till you sell. But if my portfolio account drops anymore, so therefore you can see some buffered ETFs start showing up in your portfolios. And again, just trying to manage that volatility, to keep your emotions in check, if you will. However, though, if you are aggressive investor and you have best of breed names, nothing that this recession doesn't have anything to do with Apple or Amazon or Google or some of the other good names out there. You're just going to simply hold them through. Volatility does bring opportunity. There was a comment yesterday from Josh Brown, and I have to paraphrase it because I couldn't remember it exactly, but volatility is what wealth building is all about. He's like, it is this time when this is that ultimately you're shifting money from those who are not good at investing to those that are good at investing, because this is the time to wake up and fight. This is not the time to watch CNBC and freak out, but this is time to pick through the ashes of the place after it's been torched, and look for opportunities, right? And be excited about those opportunities that you find, trying to put either new money to work through your 401ks or out of your bank account if you have it. And also, reinvesting dividends. It's a small amount, but certainly you're buying more shares at a lower price now. So it is truly, if you're in a long-term journey of wealth building, you'll see these from time to time, and you're not as affected as some of the short-term folks, or if you haven't been at this a while. So yes, I do ultimately, Allison, yes, I do expect a recession. I think the market's it is either already priced it in already, or it's going to continue to price it in pretty ugly. So I think once a recession shows up, believe it or not, and history is on my side here, the market actually starts to continue higher once the recession is upon us, because then kind of what recession it is and how bad it's going to be.
Last, Jay Powell, the chairman of the Federal Reserve, spoke earlier this week and said the Federal Reserve remains committed to beating inflation. Can you explain the process for the Federal Reserve raising interest rates to slow the economy?
Sure. Chairman Powell spoke yesterday, as you said there, Allison, and then of course, I believe it's the Kansas City Fed chief just spoke this morning, Esther George. Well, the cycle, right? So every 6 weeks they have meetings, and then they make decisions, and coming out of that, they make their announcement, right? So, and last one, they raised it 0.5 point for the first time in a long time. And 0.5%, not 0.5 point, 0.5%. But get this, don't forget. And then of course, every other 3 weeks, they release the minutes so you can kind of see what they're saying. So that's the Fed cycle. Now, can you do out of cycle raises? Yes, absolutely. They can meet on the side and announce. They do not need to time their announcements with the Fed meetings. And I would think right now it would be the perfect example of, look, the stock market's already ugly. Even though Esther George this morning said the stock market is one of the considerations that the Fed looks at, I think that's absolutely a foul. I think she'll get some flack for saying that. And I kind of hope it's just not true. But they really shouldn't be looking at the stock market, right? The stock market prices in, what everybody thinks something's worth. So let it do its thing. If people think Apple's worth less, then people will sell, and others will think it's worth more and they will buy. That's why all this works. But the Federal Reserve looking at the stock market is kind of akin to a CEO looking at their stock price, right? If a CEO focuses on stock price, he or she is going to make all kinds of decisions that are poor long-term decisions, right? Because they're trying to affect something. It's like, no, you go out, you do your best, and you'll be rewarded with the appropriate stock price as the masses judge you, if you will. So back to the Fed, though, I don't want to scare you too much, but I did pull up, if you can see this. Again, this is thebalance.com. I can't vouch for their information, even though they seem like a legit website. But the Fed funds rate reached a high of 20% in 1980. Now, many of us were alive in 1980, but do we really remember the inflation? I kind of remember of the inflation. I'm 52, so people that are older than me probably have a little better memory of that. But for the most part, over half the world is not going to really remember what life was like when we had double-digit inflation for a couple years, or year over year over year, that sort of thing. So realize that when the Fed is combating, raising the Fed funds rate to combat inflation, they are at a whopping 0.75 right now, right? They raised a 0.25 point, or 0.25%, and then 0.5%, and projected to be up to 2 or 3. Well, if they take the same measures we did in the 80s, we're basically going to delay that for 5 years. Why in the heck would we delay this horrid situation for 5 years, right? So I do think that, and I think the odds of them doing an out of cycle rate hike are low, but I think that that's what I'd be pushing before if I was sitting on the committee. It's like, look, we know what we have to do over time, instead of let's, this is more of a rip the Band-Aid off and solve the problem sort of leadership, versus what we tend to see more of is the slow and steady, let's not upset anybody, that sort of thing. But I really think we could see an out of cycle rate hike, or even a higher than a 50 basis point rate hike in the future this year, to get us anywhere near where the Fed funds rate was back in the 80s. Now, I'm sure this has been studied endlessly, and maybe that was considered a mistake or an overreaction to the upside. But certainly, I think our slow and steady path to raising rates to combat inflation is going to be too slow for most of us who would prefer to just kill the beast out there and then move on with our lives. So if we do a slow and steady rate, that means that the market will probably stay suppressed longer before we can get back onto what the U.S. is meant to do, and capitalist society, make goods and services that benefit everybody and profit from it. So overall, just that's a consideration, a reminder to everybody that you could wake up one day with the Fed, raised rates out of cycle. It has been done. It is in their toolkit, and they could choose to do it if they want.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar. We'll see you back here tomorrow.